It's the week before Christmas, and there's a lot of celebrating going on. And celebrating it is in the stock market. We seem to be going straight up. People are wondering what's driving it. And so we're trying to get to you today to give you a quick update on our views as to why the market's strong and where it's apt to go next year. Basically, the stock market is beginning to come to grips with the reality of a tax cut. A tax cut that will lower the corporate rate from 35 to 21 and the upper individual tax rate from 39.6 to 37. There are other breaks in there. There are other factors, but those are the big factors. I'd rate this tax cut a B minus to a B. It's good. It's not perfect, and it's better than the version that originally came out of the House that I rated a C plus to a B minus. Bottom line is we're getting a supply side tax cut. The votes seem to be in line, and people are running around, investors are running around trying to figure out what it means to a particular company, A or B. I think this will provide the stimulus needed for the stock market and also for the economy next year. So next year ought to be an economy that may grow up to 5%. And with that growth, you're going to have a lot of company earnings improve at a much higher rate. So that combination could take the stock market up to 30,000, measured by the Dow Jones average in a couple of years. It's not rocket science. You can get there very easily. We've had a lot of deregulation, which is really positive for corporate earnings, and that's been going on for a year since Trump was sworn in. And now you throw on top of this a tax cut of this magnitude for corporations, and it's easy to add to that economic 3% that we're at and get to a much higher growth rate. Throw in 2 hurricanes that have to be rebuilt, and you get to 5% easily. And with a 5% economic growth rate, we haven't seen that kind of growth in decades, and certainly not in the last decade. So it's catch-up time, and people are trying to catch up and figure out what the tax cut means. But most people think about a tax cut in a linear fashion, an arithmetic fashion. So if you get a tax cut of 10%, you can expect growth at 10 in earnings or something of that order. Not so. Supply side economics is exponential in its effect. It's not arithmetic. So people will undershoot all the time in terms of objectives. And so I think there's more strength in the stock market. What could go wrong? Oh, we could have some mismanagement of debt because there is still debt accumulating in our country, and the Treasury could bumble that. We could negotiate ourselves into a hiccup over trade, even a trade war. That's possible. A conventional war, that's very possible. So we'll stay on the alert for this kind of thing. But by and large, I do not think the market is drastically overvalued. Some are, the Amazons, the Googles, those that have flown for a couple of years here are at a rich price. But your typical company that relies on economic growth is still properly valued. So hang in there. There's apt to be a correction early in the year as people wait to take their tax gains and move it into another tax year. So I expect some selling, maybe on the magnitude of 500 points, 600 point type of a decline, and that would be healthy. But we're hanging in there and still bullish. And above all, we want to thank you for your continued loyalty, and we wish you and yours a very Merry Christmas from all of us at Kadena & Company.